Before I get this video going, this Dave Ramsey video going, and a contrast opinion, I want to present a real life scenario of how a 7% increase in value in prices is a very high probability scenario by the end of 2022. And here's how I'm looking at a real life scenario, and that is the townhome that we just sold in Flagstaff in March, end of March 2022. So here we are, we have a comp in the neighborhood. Now we have 9 comparable homes for sale, ranging from the low of $641 with a $6,500 concession. So that's actually $634 to what our current scenario was, $550 purchase in March of 2021 and selling in March of 2022 for $701. So if $701 is the new comp and effectively the lowest for sale home that's been on for 33 days is now down to $634K with the concessions. We had no concessions. That you could very high probability this guy would take $600,000 after being on the market for 60 days when he originally bought for $445. So he's got a ton of equity, and he's only been in it for maybe 2 or 3 years, maybe 19 or 20 is when this guy bought. At the end of the day, that's what we're going to say, a 7-10% increase. But from the peak, that wouldn't be true. So I hope you enjoyed the video. Thanks. Okay, so it's official. The feds have raised rates by 75 bips. That means if you had a home equity line of credit at 4.25, now that rate is 5%. If you had credit card tied to prime, well, now it's up 75 basis points. And today I want to go over a video by Dave Ramsey that's floating around that says it's a great time to buy. Right now is the best opportunity, is what Dave says. But let's dig a little deeper and find out who exactly Dave Ramsey is talking to. So he says, over the next 5 years, this could be your great opportunity to get in because real estate only goes up in the past 30 years that he's been in business. So that would put us at 1992. So I went and did a little research back to 1991. So I went to 1991. And in fact, in 1991, homes were at around 196 average medium sales price. And by 1996, they had fallen 10% to 177. So that was a 5-year decline and 10% decline. That's not that much, but I'm gonna go back on Dave and say that's inaccurate to be telling people that real estate never declines. Now, from 1991 to today, obviously we're in a different place, but those 5 years it did decline. And if it declined 10% and you had a job change, a divorce, whatever, and you needed to sell your home, you were going to lose money through that 5 years. So real estate is a long game. So let's go see who Dave's talking to. And let's check out this clip here.
They're going to go up every year for the next 5 years. How do you know if you're ready to buy a house? Because if you're ready to buy a house, you need to buy now. Right. Here's how you know if you're ready. You're out of debt, you have an emergency fund of 3 to 6 months of expenses, and you have a good, strong down payment. 20% is preferable because you avoid PMI. If you're a first-time home buyer, sometimes you only put down 5% or 10%. That's okay, but you're going to pay that stinking PMI. Get ready. Then when you buy on a 15-year fixed where the payment is no more than 1/4 of your take-home pay.
Well, I can't afford the house I like that's got the granite countertops.
Then you can't afford that house.
Okay, so Dave says what's being left out of this video circulating, he says, yes, it's a great time to buy if the mortgage payment is only 30% of your income and you do a 15-year fix. So with today's Maricopa County's average sales price is around $450,000. So let's look at where 6% on a 15-year fix would lead us. Well, that would lead us to a $3,600 a month payment roughly, and 30% of your income would be roughly $10,800 a month, and that would be $129,600 a year. So the average income right now in Arizona is $63,000. And so that would put 129 in the top 10% earners. So he's only talking to the top 10% earners, and he's asking you to buy a $450,000 house and pay $3,600 a month. I don't know anybody buying a house for $450 a month, $450 and wanting to pay $3,600 a month. People buy off of payments, something they can afford. So most people buying, making $129,000 a year are not wanting to live in a $450 entry level. That's where our entry level homes are. That's 1,500 square foot 1980s home. You might look in zip code like 85304 in Glendale, where our starter home is, and you're going to see, you know, $399 to $550. Crazy. Okay, so the next video I want you to watch here is contrary to what Dave is saying. He's saying wait 6 months, and you know, let's watch the inventory build. Now, one thing you can always change is the interest rate. You can always refinance, right? But you can never change the price of which you paid for the home. That is said and done once you sign the contract and it funds, right? So buying at the right price when affordability matters, because affordability matters. So we're going to watch Nick from Reventure Consulting.
For instance, just over the weekend, the U.S. mortgage market ground to a halt. It broke. This is a story that the mainstream media isn't covering yet, but they will by the end of the week. Because take a look at what this 40-year mortgage veteran in the housing market just said. During my last 44 years in the mortgage industry, 4 painful moments stand out. Today makes 5. The red-hot inflation report from May was so awful that it changed the bond market's view of Fed trajectory, and as a result, the mortgage-backed security market went no bid. There were no buyers for mortgage-backed securities. Mortgage purchase applications, a forward-looking indicator of housing demand, have already crashed down to 2016 levels. Well, the crash in the mortgage-backed security market on Wall Street means that we can expect this mortgage application figure to crash even further down to the same levels we experienced at the depths of the last housing crash in 2009 and 2010. The personal savings rate in America is now near a record low 4.4%, meaning that Americans are only saving 4% of their income on average. The last time personal savings was this low was 2007, 2008, right before the worst financial crash, the worst recession since the Great Depression. Similarly, consumer sentiment is now at an all-time low level. The confidence that Americans have in their finances and the future of the economy is now lower in June 2022, according to the University of Michigan, than it was in 2007, 2008 before that crash. And ultimately, the weak financial state of the U.S. household and consumer in 2022 is one key difference between today's inflationary environment and then the inflation in the 1970s. So I want you all to take a look at this. Pay special attention because this is so important for you to understand the future direction of the economy, to understand this difference between now and the 70s, that back then, personal savings rate in America, how much Americans were able to save was 10, 11, 12, 13, 14%. Americans, even during the 1970s inflation, were able to save more than the cost of goods was going up. Today, it's the exact opposite. The cost of goods is going up much faster than Americans' savings, which ultimately means that the inflation is not going to be able to sustain itself as Americans at some point.
So now I want to also mention Jason Walters. Jason Walters has a following of 30 to 40,000 subscribers. He brings great daily information to the housing market. So he's mentioning here that Redfin stock has dropped from like, I think it was $97 down to $8 a share. They're laying off 8% of their workforce. We also have Compass, who now has their stock frozen. No more trading, they're frozen, and they're laying off bigly. So these are all indications, along with layoffs that Nick mentioned, that we're seeing today. So let's listen to Jason here, what he has to say about Redfin.
14th of June. It says here Compass is going to lay off about 10% of its workforce, whereas Redfin will cut about 6%. For Compass, these cuts total about 450 employees, and that will contribute to an estimated $21.5 million to $23 million in costs before taxes in the second quarter. And because of this announcement here, the stock for Compass as well as Redfin has been tanking. So the stock for Compass is now down 75% less than its initial public offering of a price of $18 a share in 2021. And obviously Redfin has been tanking as well, down almost 92% since the peak in 2021. So check this out because this is pretty crazy. So again, Compass IPO'd at $18 per share. Now at the time of this video, $4.26. As of today, they're down 10.5%, and year to date, they're down 55.39%. And Redfin stock is down almost 5% today. They're also down 79% year to date, and also down 86% compared to 1 year ago. That's an index based on requests of home tours and other home buying services. So 2022 is this red line here. I've been reporting this to you guys for several months now, but as you guys can see here, 2022, they were at levels above 2021 until April hit. Obviously, April is when mortgage rates hit 5%, and now rates are closer to 6.3%. But as you can see here, their index for home buying services absolutely tanked ever since then, and now they're down 12% compared to 1 year ago, on par with 2020. It also says on Redfin's website here that this was the 8th consecutive week of declines in their index for the week ending June 5th.
Very interesting. I appreciate it. If you want to go follow Jason Walters on YouTube, Nick from Reventure Consulting, those are two great YouTube channels that I really enjoy. I get a lot out of. Nobody has a crystal ball, but these are great facts and figures, and I hope it brings a lot of value to your day. And I appreciate your time for watching. Until next time.